What's up, everybody? Chris over here, founder and proprietary trader, whatever, Pollinate Trading. Today, I am with Jeff Dorman. He is the co-founder and CIO, Chief Investment Officer of ArCa Invest. ArCa, no, that would be ARK Invest. Sorry.
Just ArCa.
I'm actually wearing an ARK shirt. That's funny. He leads the investment committee. Responsible for portfolio sizing, a very important tool, of course, trading and risk management. Big fan of sizing, by the way. He's got over 17 years of trading and asset management experience, which he pointed out includes he personally has a much higher market cap than the first two firms he worked at, being Lehman and Merrill Lynch. Went on to oversee trading of $100 million prop capital at Citadel. COO of Harvest Exchange, a fintech company widely used by asset managers. He's a CFA charter holder, has a BA in finance and economics from Washington University in St. Louis, and hails originally from Cleveland and currently in Southern California. What's up, Jeff?
That's correct. What's up, Chris? Good to be here, my man.
Likewise. Let's first of all, actually, we had a little power failure a second ago, but so we had to restart it. I was going to say, let's jump right into one of the first questions, but actually wanted to get your hear about ArCa first so that we can frame instead of just going right into it.
Yeah, absolutely. So we formed ArCa about 3 years ago. As you mentioned, we're Los Angeles based, although we have offices in New York, and now in this new remote world, we have offices everywhere. But we started ArCa 3 years ago. We're a full service asset management firm focused exclusively on digital assets, and that includes two sides of the business, one of which where we are actually actively investing in the companies and the digital assets themselves that are driving this new asset class and this new ecosystem. The other, ArCa Labs, where we are using blockchain as an infrastructure or as a wrapper to create traditional boring investment vehicles. For instance, we launched what's called ArCoin, which is a short duration government bond fund, but the shares trade exclusively as peer-to-peer Ethereum-based digital assets. So we're doing a lot of things around digital assets, both using them and investing in them across the entire firm.
All right, so ArCoin, let's jump right onto that then. So an ERC20, basically I go into my MetaMask and I find ArCa. How would I find ArCoin and how would I be able to get an investment into that?
Yeah, absolutely. Right now, you'd have to do it exclusively through our website. We've been working for about 2+ years now with the SEC on the fact that this is a new type of product, right? It's an old school 1940 Act structure, but the first time ever that shares can be traded peer-to-peer via blockchain. So as of right now, the shares can be purchased directly through our website after going through KYC. But ultimately, as you mentioned, these are digital assets. They're going to be traded on exchanges with market makers, peer-to-peer, et cetera. It is a Ethereum-based token. So to your point, yes, you would hold this in your own wallet and you can do what you want with it. We are basically bridging the gap between what historically was just investment vehicles and now payment vehicles, all into one digital wrapper.
Right. So now is it just basically we're just making the premium on you said short duration bonds? Clipping coupons kind of returns on the coin, or how is it?
Yeah, for this first vehicle, we wanted to use the safest, most liquid security in the world, which is U.S. Treasuries. Ultimately, just like the ETFs can basically package anything into the ETF structure, we call this the BTF structure, blockchain transferred funds, and ultimately we will have other BTF structures as well. But the pilot product was the ArCa U.S. Treasury Fund, which is basically just a like I said, short duration, low yield, low volatility product, just to get the pipes going with this new structure.
So kind of like a proof of concept for traditional bond investors, so that they feel comfortable with the asset class.
You got it.
The technology, I guess, is a better way to say it, not asset class.
Absolutely.
That's good. So this would be considered. Not alt in the altcoin, but alt in the sense of alternative investment. So KYC AML, just like you would any hedge fund type investment or any alternative investment class.
Yeah, I mean, this is an investment security, right? This is an investment security that is simply using blockchain as the wrapper for transactions. I mean, we at ArCa believe that ultimately every asset is ultimately going to be digitized at some point. Obviously, to date, most of the things in the digital asset world are sort of in that regulatory gray area, right? We assume they're all securities. The issuers of these tokens like to assume that they're not securities. The truth is we don't know yet, but there is a handful of asset-backed tokens, truly asset-backed tokens, or tokens that have gone through SEC registration processes. And these are straight investment securities. The only difference between that and a typical bond or equity is again simply the ability to buy, sell, and ultimately transfer these vehicles via blockchain.
You guys have any other traditional type products you can talk about that you're looking to bring online?
Nothing we can talk about yet, but yeah, part of our ArCa Labs division is launching a lot of these different products.
Gotcha. Very cool. So that's very interesting. I saw the ArCa coin. I didn't really take a chance to dig down it. But yeah, that's very cool. I guess maybe I'm getting into the plumbing too much on the business side, but so the investor would have a wallet. So I custody your product. And of course, there's a small management fee in the smart contract, I assume, right?
Yep, absolutely. And ultimately, there are third-party custodians that are working with us as well. We have made a few announcements recently with regard to some of the custodians who have agreed to custody our coin. But that is ultimately your choice, right? The whole purpose here of digital assets is, you have a choice now between self-custody or using more traditional, workflows that institutional investors are more comfortable with. So, we're trying to make the product itself the innovation, but the workflow with regard to how investors or how individuals use it is entirely up to them.
Yeah, that's great. Yeah, that's really good. I like it. And you onboard people into the digital framework of having a wallet.
Absolutely. Yeah, I mean, a good example of that would be, look at all the pressure corporate treasuries are under right now after what MicroStrategy and Tesla did. Right now, every corporate treasury in the world has at least one or two junior people right now researching Bitcoin and researching digital assets. Well, you can get involved with digital assets and blockchain and learn about custody and learn about wallets and learn about all the things that come along with blockchain without necessarily taking the price risk, using a security like this. Right. So there's a lot of different use cases, but ultimately, I think that's where we get excited is what you just said, which is that ultimately we believe everybody is going to adopt digital assets in some way, shape, or form. Historically, Bitcoin has been the on-ramp for everyone. It doesn't have to be that way. There's certainly a plethora of digital assets out there, including some that we're launching and working on ourselves that will get the world into this ecosystem. And once they're in the ecosystem, I think we all know, there's a whole lot to do once you're inside here.
Yeah. And that's what is great about crypto is just anybody can pretty much, take their strength and apply it, which you guys are taking your more traditional Wall Street strength and saying, okay, we'll pick up the pack here and we'll haul it up the mountain with the legal regulatory traditional finance side, which is hard for a lot of other people in crypto to get involved with because, they don't come from that background. So that's,
yeah, absolutely.
Natural progression.
We pride ourselves in being the boring guys from Wall Street who are here in digital assets. I think, rightfully or wrongly, this asset class seems to have that cowboy persona. And certainly when you have some people who have gotten into this space after, being heroes in the macro trading world or in the, algorithmic trading world, there's that perception that everything is sort of the wild, wild west. We think otherwise. I mean, we think this is the future of finance, and sometimes you need to walk before you run and get the boring products out there first to give people the vehicles that they feel more safe and are more appropriate to what they're trying to accomplish. And then ultimately, like we said, this is a completely different workflow, a different world. Once they're in this world, anything can happen. I joke with people that, I was never a gamer myself, but once I had an iPhone, somehow Angry Birds ended up on my phone. That's what's going to happen here, right? You might come to the digital asset world via Bitcoin or via ArCoin or via something else. Once you're in, there's a whole lot of other things that might end up, on your phone or on your computer that you might play around with and mess around with and ultimately have some fun with.
Yeah, that's absolutely the case. We all know the path really, really well. And if you don't know the path really, really well, you just heard it. So that's until I meet the person who doesn't go that route, we'll probably stick with that scenario. Let's First thing, I had to reach out to my community and ask them. I posted your most recent blog post, and one of our guys, not cowboyish by any means, crypto Derek Zoolander, uh, yes, what criteria do you evaluate before investing in a new crypto project?
Sure. So my team all comes from different areas of finance. Besides just me and my boring Lehman Merrill Citadel resume, I've got a gentleman by the name of Hassan Basiri who spent 12 years doing international M&A, cross-border M&A at KPMG. I've got a head of research who spent years doing early stage due diligence for crowdfunding platforms and venture capital firms. So we're a little different than some of the other financial firms in digital assets. Historically, when we came into this space, at least, there was really only like two kinds of investors, right? You had your algorithmic quantitative investors on one side who, quite frankly, didn't care what they were trading as long as there was high volatility and correlations and liquidity. And you had your venture capital firms on the other side who were really good at seeing the future, but weren't necessarily taking advantage of what this asset class had to offer in terms of liquidity and different attributes of tokens and even just capital markets events and catalysts. So we kind of fall in the middle. We're not doing super early stage investing where it's pre-product, pre-revenue, pre-launch, but we're also not waiting until these things have the liquidity profile of Bitcoin to start whipping them around because we can trade them 100 times over. We generally look for strong management teams. We generally look for tokens that accrue real economic value, meaning just like the corporate bond market, and there's an infinite combinations of coupons and maturities and call structures and covenants. We look for tokens that have the right attributes, right? Whether it's an amortization feature, a dividend type feature, some sort of velocity sync, something that accrues economic value to the token itself. And then we look at the metrics. We look at the real KPIs. We're looking at, is there user growth? Is there volume growth? Is there transactions? That's basically what we are looking for when we make an investment. And ultimately, we do it top down. We come up with themes that we think are going to be powerful drivers of economic gains. And then we go bottoms up and we say, okay, well, now that we understand the theme, what's the best way to express that theme? And is there an instrument out there that will help us do that? And the reason that last part is so important is, look at Bitcoin and its saturation right now. There's, an infinite amount of Bitcoin products, it seems like right now, and they all have incredibly different return profiles. Like I was just looking at the Grayscale Trust, GBTC versus actual Bitcoin. Over the last 3 years, starting in the summer of 2018, GBTC has underperformed Bitcoin by about 300%. 300%, not 300 basis points, 300%. That's insane, right? You think you're getting exposure to the theme that you want, but you expressed it in the wrong vehicle. And that's ultimately what we try to do is we say, whether it's Web 3.0, DeFi, sports and gaming, digitization of the fan experience, you name it, we come up with a theme and then we look for the instruments that are going to help us express that theme.
Nice. Have you faced much challenge with it being a U.S. or I guess I don't know if you have an international fund or an international product as well, but let's just assume we're talking about U.S. based. Have you found that to be a challenge, getting access to what you want to get access to?
Definitely, if you're a U.S. individual investor, there is some nuances between what you can and can't invest in. Right, the U.S. Certainly, in some ways, they're doing regulation the right way. Right, they're purposely slow playing it. They recognize that they don't want to all of a sudden have sweeping regulation that is going to be obsolete in 3 months because the industry is evolving so quickly. But at the same time, it's sort of embarrassing that the U.S. is on the same list with North Korea and Iran with regard to like countries that can't access certain sites. So there's definitely that tug of war right now between the right regulation and too much restriction. With regard to us and our structures, I mean, we are capable of investing across the globe, and as a result, there hasn't been any restrictions to what we're doing. But there are definitely some opportunities that U.S. investors are missing out on as a result.
Yeah, I mean, it's tough when you're getting 200% a year every year on Bitcoin to really feel bad about ourselves. But
well, but
yeah,
it's funny you say that, but I think it's totally different, right? I mean, I think Bitcoin and every other digital asset started in the same kind of mold where they were all sort of the same assets at first. Nobody really understood what the differences were. A lot of times they had the same trading pairs, so as a result, there was natural correlation between them. This asset class has changed a lot in the last 3 years. Bitcoin is really more of a large cap macro asset now that is much more tied to the dollar and rates global monetary policy than it is to other digital assets. And similarly, most of the assets that we're investing in within our funds are the opposite. Our correlation is going down versus Bitcoin, and the correlation is going up versus the Russell 2000 and the NASDAQ, because for the most part, these are early stage technology companies that are growing with real revenues and real cash flows, and have simply found a new medium for capital raising via token, and basically has inserted a token into their capital structure next to debt and equity, and have found different ways to distribute value back to their token holders. So in some ways, yes, you're right. Like Bitcoin has been a great investment, and you don't need to invest in anything else. On the other hand, they're not even comparable anymore, right? It'd be the equivalent of me saying I'm an ETF investor, and they'd be like, well, what does that mean? Do you invest in healthcare ETFs, or do you invest in high yield bond ETFs? Just because you invest in digital assets doesn't mean they're all the same. And I think that's ultimately where we find our alpha, but also where investors are slowly starting to understand that. They still come to this asset class usually because of Bitcoin. That's usually their first starting point, but they are starting to recognize that there's more to it. And it's a challenge because the media talks about Bitcoin all the time. A lot of the richest and most powerful celebrities in this space are Bitcoin only people. It's very difficult to untrain people. It's almost like if you ever had someone walk into a golf course with a bad swing, and after a few lessons, you're like, why don't we just switch you to the other side? Because we're never going to fix this bad swing. It's kind of what we're doing in some cases with some of the investors we speak to. Is like, they're so focused on Bitcoin and cryptocurrency and how they're all the same, that we have to almost erase their memory and start over and be like, no, there's a very big difference between a cryptocurrency and a protocol or a platform, and an asset-backed token and a pass-through token that's generating real revenues. So, it's an education journey. And I would say that people who are only invested in Bitcoin are not necessarily missing out, but they're definitely missing.
Yeah. Well, there's the DeFi situation, or which I guess is more broadly, I guess, actually, let me throw that one back, and let's talk about Web 3.0, which is everything on, basically going Web 2.0 being mobile, Web 1.0 being here's the internet, Web 3.0. I'll let you take it from there on what you're looking at, how you categorize Web 3.0.
Yeah, I mean, to me, Web 3.0 is simply taking all of the same tools and services that we've been accustomed to on the internet that have historically gone through a data provider or a service provider, and now being able to do all of those same services, but being able to be in control of your own assets and in control of your own data, right? Most of the growth on the internet has come from the intermediaries, right? The Facebooks, the Amazons, the Netflixes, the Twitters, et cetera. They're collecting your information, and they're utilizing that information to grow their businesses. But that information is free to you from a cost standpoint, but ultimately you're paying with regard to the data and the information that you're putting up. Why aren't we more in control of that data information? And that's part of what Web 3.0 is all about, is allowing you to have these same access points, but to control your own fate, to control your own data. And whether that means, if you're a content creator, or you are a lurker or a browser, or you're an advertiser, et cetera, it's just being able to target more of this directly to the consumers without having to go through those centralized parties. So there's a lot of facets of Web 3.0, from file storage and archiving, to ultimately, like I said, content creation and advertising. But ultimately, most of these are still in the early forms. It's harder than people think to change workflows. We might all hate Facebook, empirically or ideologically, but if that's part of your workflow, it's kind of hard to change until someone else comes out there that has 2 billion people on there and all of the same features and services that Facebook has, right? So it's going to take some time. I think it's definitely going to be more about UI and technology than it is going to be about ideology. We can all say that we hate giving up our data, but when it's much easier to do it than it is something else, you might not do it. So it's going to take some time, but there's real growth happening in Web 3.0, and we're certainly excited to be investing alongside that growth.
Yeah, absolutely. So from that, we get into, I want to go down into the DeFi spot. Kind of, it seems that your focus from giving somebody let's swing left-handed in the golf course instead of the right-handed, to starting getting people out of Bitcoin, which I probably would assume also means Ethereum, like as an asset versus as a utility or as a protocol. I imagine the majority of your work is probably on that sort of the Ethereum or other networks like that, I guess layer ones. How involved are you guys involved in DeFi summer and everything that's happened there? We're at what, 43, 44 billion total locked value in the DeFi space. I imagine that's not just a bunch of crypto Derek Zoolanders. It's probably some real funds involved to make a number that big. How involved are you guys in the DeFi space?
So we've been very active investors in the tokens that are backing and supporting these DeFi protocols. In the specific fund vehicle, our flagship fund, we are not putting any capital at risk in the DeFi ecosystem. We are launching other vehicles, and we have some proprietary capital where we are researching and using these vehicles. But like any hedge fund, we don't participate in style drift, and we have a mandate. And in this particular fund, we're not doing that. But ultimately, DeFi is real, and there's a lot of opportunity in there. Ultimately, when we first started investing in DeFi about 2 years ago, truthfully, we were kind of just taking like a blind basket across different pockets of it. I remember actually sitting around a round table with my team, and we were like just trying to map out DeFi. And we're like, well, what is there? There's asset management, there's insurance, there's decentralized trading, there's lending and borrowing. How do we get broad exposure with a small percentage of the fund across a lot of different things? Now it's much more traditional financial analysis. It's not spreading your bets around different areas that may or may not work. Now you have real cash flows and real revenues to look at from an investing standpoint to make real decisions using DCF analysis or yield analysis, et cetera. And it's probably some of the cheapest securities on the planet out there in sense of price to sales and price to earnings, coupled with the growth and the yields that are being generated here. What I think is interesting, though, is we hear a lot of naysayers talking about DeFi and being like, it's too risky, you can't use it. And you can just tell right away when the people say that one, they've never used DeFi, and two, they don't quite understand how it works, because there's a huge difference between investing in the token that ultimately has bootstrapped and captures the value of a protocol versus being the one who actually submits the capital into the protocol and has the capital at risk, right? It'd be akin to saying, I'm afraid of crashing in a plane and therefore I can never buy Delta stock. And that makes no sense, right? Because other people are using the planes, and therefore there's going to be revenues, and therefore there's going to be accretion to the Delta shares, even if you never fly a plane yourself because you're terrified. So that's the best way to describe this. And we can actively invest in this ecosystem, even if we're not using it. Now, the flip side of that is this asset class was designed to be active participation. It wasn't designed to be a passive investor, right? You do get more out of it when you are an active participant. If you are providing the capital, or you are using your assets as collateral, you will definitely get higher yields and higher returns than if you are a passive investor. But that doesn't exclude you from being a passive investor. And I think that would be my takeaway, is that at the individual level, everybody should be experimenting with DeFi right now and putting some assets in MetaMask and connecting your wallets and testing some of these different features. At the investment level, you probably should find the ones that you actually enjoy using and make some investments. And they don't have to be mutually exclusive, but they can be.
Yeah. Well, and one of the most obvious easiest ways, I should say, to get into it on these major crypto bank exchanges, Kraken, Gemini, Coinbase, for us in the United States at least, where Kraken has lacked in their UX skills on the main platform, their UX in the staking platform that they have, you can just jump on there and stake Polkadot or even better, Kasama at the moment for 12%. They're paying 20% if you stake on, if you go into the real DeFi world without that nice, pretty wrapper on it. So they're making an 8%, they're making 8% off you, but where else are you getting 12% on, a token or on something that's just that easy to get access to? So I would say,
well, and that's the irony right now too, is that there's trillions and trillions of dollars of wealth out there that are doing anything they can to get a 3 to 5% yield and physically can't get it anywhere, right? And then meanwhile, you've got this incredibly flourishing DeFi ecosystem where most of the participants don't want 5 to 10%. They're looking for 5 to 10% per hour.
Right.
And so you have this mismatch right now between what's available in the digital asset world relative to the type of investors that are in here versus what's available in the real world compared to what they want. So I think it's only a matter of time before these worlds converge, right? These yields are valuable and people want to earn them. But I do think it's also really important for investors of all sorts to understand where these yields come from, right? There's a difference between staking and earning inflation rewards, right? Which is essentially a company or project basically rewarding you for being an early user by giving you more tokens or more, not shares obviously, but the tokens represent the quasi equity. That's a very different type of return than if you're using a centralized exchange or like a Blockfi or a Celsius or a Nexo, and you don't really know where that yield is coming from. And I think that's part of the power of DeFi, is that everything's on chain and you can see it all. You know exactly where that yield is coming from if you decide to lend assets to Aave. You know exactly where that yield is coming from if you stake an asset directly with a protocol or platform. When you're doing it through a centralized company like Kraken, or you're doing some sort of yield enhancement through a BlockFi, Celsius, Nexo, et cetera, they're basically just hedge funds, right? You don't know exactly what they're doing. And I don't use the word hedge fund negatively. I run a hedge fund. I think it's I think risk is a great thing. Risk is a terrible thing though when you don't know that you're the one taking risk. And I think that's where, to me, the centralized exchanges and the centralized companies need to do a better job of transparency, right? For anybody who has kind of followed the grayscale arb trade and BlockFi, for example, like BlockFi is a great company. These guys just got a $3 billion equity valuation. They are definitely doing the right things from a risk management standpoint. The problem is they're acting like a bank. You go there and in 30 seconds you sign up and you deposit your assets and you think you're just earning some risk-free return on your assets. When in reality, behind the scenes, they're doing risky arbitrage lending and grayscale arb trades and all these different asset liability mismatches where at any given time, there could be a blow up. And again, I don't think there will be a blow up at BlockFi. I know that team. I think they're very good. But why aren't they disclosing it, right? Their answer is we're going on podcasts and we're talking about it, but they're not disclosing it on the website at the point of purchase, right? It's the equivalent of, if I buy a chocolate bar and they refuse to put any of the sugar information on the label, but 3 months later, I go on a podcast and I hear that I'm, ingested, tons of fat into my system without knowing it. So I think there is an obligation to be more transparent. That being said, again, as an individual, you should absolutely be experimenting with these things and trying to learn where that, how do I generate these yields? How do I get these returns? But also don't be afraid to ask questions and be like, wait a minute, if this sounds too good to be true, maybe it is. How are you generating it? What are you doing? And, I think it's incumbent upon everybody in this industry to seek those answers and demand those answers.
Yeah, well, that you wrote a great piece on that 2 weeks ago about BlockFi and where all that money was. I mean, BlockFi's done an amazing job of figuring out how to do inbound marketing, basically for a hedge fund, right? I mean, how many hedge funds would love to have the advertising capabilities of what BlockFi has to get, and take investors of like, here's $5 as opposed to a minimum of 100 and, all those other 1940 Act stuff.
Yeah, exactly. And people hate regulation, but that's the reason for regulation, right? Like, how does a hedge fund pretend it's a bank, even though it has no bank protection, and take in $10 billion of assets from $5 at a time from people? But a real hedge fund has to only take accredited investors and qualified purchasers and go through 18 months of due diligence hell before you can take money. When in reality, you're basically offering the exact same service. You're taking risk to provide a yield. And I think, ultimately, that's where regulation can be a good thing, is in making sure these risks are disclosed. And I think the accredited investor law is stupid. I'm all for people being able to do whatever they want with their money. But again, you should understand what's happening, right? And there's an example of that. There's a small company called Cred Capital that recently filed for bankruptcy. And they lost about $100 million of customer assets in the course of doing this, and none of those $100 million of depositors had any idea the risks that this company was taking. And that's a problem. That's a real problem to me, right? Again, I'm not some ideologist. I'm not like, everything has to be decentralized or nothing can be centralized. I think consumers and individuals and investors should have choice, but that choice should be educated. And education is something that especially the younger generation now, the millennials, and they're very good at it, right? They like to be self-taught. They like to go on Robinhood and mess around. They like to go on Coinbase and mess around. But we can't intentionally hide information. People should be able to research and find that information and make educated decisions on what they're doing with their capital.
Yeah, that's absolutely the case. And, certainly people like you coming on podcasts and doing these sort of things, giving it from a different perspective, is definitely useful in the business where, and this, to BlockFi's credit, I guess this is probably where a lot of their let's call them LPs. A lot of their people probably were on podcasts getting it out there, but I would absolutely agree that there is a lot of that. Being like with DeFi, where you have the smart contract and you can actually see what is happening. You can open it up and take a look, say, okay, this is what they're doing, this is what they're doing, this is what they're doing there. You go to a Blockfi, you're just assuming that the nice social network type, you're the product is in your favor. We'll find out. Not that I don't have a Blockfi account, and definitely looking forward to the Visa card, but
Yeah, for sure. And you know what I mean? Like, there's also some hypocrisy there too, right? In that there are definitely hacks in DeFi ecosystems, right? We've seen some protocols be hacked. But the difference is when there is a hack, you know about it within minutes, if not hours, or certainly by days. And usually there's some sort of a remedy right away. Most of the time, when financial services firms get in trouble, it's not because they made a mistake. It's because they doubled or tripled down to try to dig themselves out of the mistake. Again, for anybody who's a real nerd out there like myself, go read the bankruptcy docket from Cred Capital. They didn't do anything wrong at first. They had a regular business where they were taking deposits and they were lending it out and they were earning that spread and paying their depositors. But when they got in trouble in March 2020, then they started going crazy trying to get the money back. They started levering up. They started making loans to Asian loan sharks at 30% yields. Like, you start doing all these things to dig yourself out of a hole. And then all of a sudden you find out that you lost all your capital and you have to file bankruptcy and you get fraud charges. So, I'm certainly not comparing a Blockfi to a Cred Capital, right? Cred Capital is facing fraud charges. Blockfi is, at least to date, very talented risk managers. But the point is, in the DeFi world, if there is a mistake, you're going to see it right away and there's going to be a remedy. Whereas you have no idea what's going on behind the scenes of some of these centralized firms.
That's true. Well, and Lehman Bear Stearns is, you can pull open the code of the project you're looking at, and like you can't pull open the code of Lehman. Yep. You couldn't at the time. Like, look, who could have walked their way, backed their way into that whole scenario or night? Like all those different firms that went down back then. At least with nowadays, all you have to do is learn how to code a little bit. You don't even have to really fully understand the code. A lot of it is just really laid out, and you just need to start writing it down, and you can figure out those sort of things. But it's the transparency of that is truly different for those who have gone through the Lehman and the Bear and all those different experiences.
Yep, 100%. Yeah, exactly. I'm not pro centralization or decentralization. I'm pro transparency. And I think you hit it on the head, right? We now have the technology and the social networks and the ability to communicate in real time, that there shouldn't be any more guesswork.
Yeah. And that makes it a lot more of a meritocracy. It's just, how hard can you work? How hard can you learn?
Exactly.
It's all there for free to get. So, okay, let's, another question we had, and this one's somewhat relevant, and this was what the original question we had before we had power issues. So last week, and you did a great job of Jerome Powell came out last week and said exactly what he had been saying for the last year and exactly what everybody thought he was going to say. And unfortunately, he did exactly what he was supposed to do. And at the, about a week or two prior to that, the 10-year yield, or, the yield basically in treasuries just started ripping, and which made for a more dramatic or a more tense moment when Powell started, when the Fed announced their information and kept everything the same. What are your thoughts on how if rising rates happen? What are your thoughts on how that might affect the general markets, the crypto markets, and the whole space generally?
Sure. Yeah, I mean, just there's a lot of things to unpack there, right? So to start with, low rates is definitely good for risk taking, right? I mean, you could pinpoint back to March of 2020 why every risk asset on the planet has gone higher. It's because the dollar was going lower and rates were going lower, right? And that forces people into riskier assets, and it also, more importantly, makes the present value of assets higher when you're discounting at a lower rate. So that was definitely good for risk assets. As rates started to rise, you could see capital rotation start to happen. Deutsche Bank put out a great chart recently looking at the returns by sector and asset class from March of 2020 to November 6th when the vaccine was announced, and then subsequently from November 6th to present after the vaccine. And you see a huge rotation. You've seen all the stay-at-home stocks, your Pelotons and your Zooms and all your tech stocks ripping from March to November. And then all of them have struggled at the expense of consumer cyclicals, banks, energy, all the companies and projects that do well in a rising rate, inflationary environment. Basically as GDP grows, those are the sectors that do better. In fact, the only asset that did well in both environments was actually Bitcoin, which had basically triple-digit returns in both periods. But so rising rates do matter in the sense that it does suck leverage out of the system. It does make present value calculations lower. It does inhibit some risk taking when you can earn a quote unquote risk-free rate again. So it definitely will suck some of that risk taking out of the system. That being said, at an absolute level, we're still at the lowest absolute yields that we've ever seen, up other than 6 months ago, and even the steepness of the curve, which is can be tricky for a lot of risk managers. It's still not anywhere close to the steepness of the curve when we've come out of prior recessions, right? I mean, I think the 2s, 10s, and 2s, 30s curve was in the 300 to 500 basis points range historically, and now it's we're talking about 150 basis points. So I don't think the levels themselves matter. What matters is when leverage unwinds, anything can happen, right? We saw it at the end of 2019 with the repo. We saw it in March of 2020 when certainly there were some firms that got bailed out. We saw it even last month with the Blockbuster and AMC and GameStop stuff, where Melvin Capital and others went under. Right, leverage is a dangerous thing, and when leverage starts to unwind, which it does when rates start to rise, then you can see the effects from that. In fact, we already talked about one of those instances, which is the Grayscale trade. Right, the Grayscale trusts have been trading at a premium to net asset value for 3 years, and now they're trading at a significant discount. And I don't think that discount's ever going away. I think that's the new norm. And that doesn't really matter if you've just taken, long directional risk in a Grayscale trust. It does matter if you were borrowing Bitcoin and converting it into Grayscale Bitcoin, or if you're borrowing Ethereum and converting it into the Grayscale ETH trust. All of a sudden, you've got leverage, and that leverage is amplifying your losses. So I think rising rates can certainly create individual hiccups within the financial market. I don't think we're anywhere close to systemic risk. More importantly, I think the Fed, as you said, is just boring now. I mean, again, we were talking earlier before we jumped on the podcast here. You as a trader on a Merrill or a Lehman or a Bear, wherever, you used to be glued to your screens when that 8:30 a.m. economic data came out, or when the Fed spoke. Now we had the worst retail sales, I think, in 2 years the other day, and the markets didn't move, and no one even cared, and half the traders were getting bacon, egg, and cheese sandwiches in the cafeteria, because it's just, we're in this new norm where the Fed is telling us where we're going, and they're not changing regardless of weekly or monthly data, and the numbers don't matter anymore. We've got this implicit Fed put. Bad news is good news, and go enjoy your sandwiches while you wait to hear when the Powell policy finally does change.
I remember the briefcase watch of what was his name? Greenspan briefcase watch on CNBC, and they would have him walking across the street with how big his briefcase was, and everybody would be making adjustments if his briefcase was a little too heavy. And I mean that's to the point further to drive the point home. There is now, that was the thing that everybody paid attention to, was his briefcase size. Now it's like they don't even pay attention to I don't pay attention to the news conference. So it's come a long way. Thanks, CNBC.
Yeah, exactly. And part of that too is this goes back to, again, just the last 10 plus years of just information flow. It's rare that you can surprise markets anymore anyway, right? All this stuff gets leaked. In fact, I mentioned the retail sales number when they were down 3% versus the expectations of down 0.4%. Well, the night before, Bank of America and JP Morgan and others were already getting the whisper number out there that, hey, it's going to be really much worse than we thought. And that's being leaked directly from the Fed, through the Wall Street Journal and to the banks. So it's hard to surprise the market anymore. And certainly, to the Fed's credit, what they have done is say, we're not going to surprise you anymore. We are going to be as boring and as stoic as can be. And good luck trying to find a single word difference between the last thing we said and this one, because there's not going to be anything. We are not changing policy. We are going to be as loose as can be. And they're going to encourage excessive risk taking until the next crisis forms and sends us into a tailspin again.
It strikes me as we're talking about that. I always thought it was a little odd that you had an attorney as the Fed chair, and as you're saying that, word for word, try to find something different. I was like, well, what better person would you want to have in that role than an attorney who really values, word economy and the actual meaning of a word, versus an economist who, we'll talk about the aggregate supply demand curve and, like kind of blind you in a bunch of things as Greenspan would or whatnot. And so that is probably, not probably, that just further validates what you're talking about, that they're truly focused on getting the exact same out there, the most boring information you could possibly get. No hyperbole, no changes. When a change happens, it'll be telegraphed months in advance. Jim Leitner is Falcon Management, done all right for himself as an investor. He's kind of the first person to really get out there and say, look, the Fed tells you exactly what they're going to do. This was before everybody started realizing that the Fed was telling you what they're about to do. It's like, if you just listen to him, he's Jerome Powell. If you listen to him, he's telling you exactly what's going to happen, and you can like plan that out for the next couple of years. So when you try to make the trade different, you're just going to give your money away to me. That was Leitner's thing, but it's absolutely, figuring that out 2 years ago was probably pretty astute on his end, and everybody else's. Yeah.
Yeah. And make no mistake about it. Again, even with rising rates, again, this is still incredibly bullish environment for risk assets, and digital assets are a part of that. Now, again, going back to what we said earlier, I think there's a completely different investment thesis for why you would own Bitcoin versus why you would own Ethereum versus why you might own a DeFi token or a sports and gaming token or an NFT token, et cetera. But they all have a commonality, which is, you are further down the risk spectrum, and that is the environment that we will be in as long as rates are low and as long as the dollar is flat to declining. So I think ultimately this is still an incredible environment for investing in digital assets. And more importantly, even if you're a mean reversion believer, if you believe that, equities at a 34 PE is unsustainable, or high yield bonds at 4.3% yields and, 5 times debt to EBITDA, if that's unsustainable versus the mean, that might be right. Those are established, markets that have been around a long time to give you data points to suggest that you're right, that these are probably stretched in terms of valuations. But in digital assets, I think this is a secular shift. And I think every company in the world is eventually going to have a digital asset in their capital structure. And I think we're just, starting with regard to what this asset class is going to look like. So even though we've gone up, hundreds to even 1,000% in the last 6 to 12 months, I don't know if you can have reversion to the mean, because I'm not sure a mean has ever been established yet. And I think that's the biggest difference between investing in a new asset class like this versus, stretching for the last, couple percent of more established asset classes like high yield bonds or equities or even real estate.
Yeah, so it's really just and you can see it on a monthly basis. Every new month, you can literally see what I guess the market cap of crypto, whatever set, whether you're looking at large cap DeFi, wherever your currencies or smart contracts or whatever different part of the asset class, or different asset classes, you can definitely see a dollar cost averaging thing that just people are saying, I'm going to go ahead and throw some exposure into this now, just on an average person's basis. And when you have those things in place, you can find yourself getting in on a Polkadot at like $3 and just say, okay, I'm buying a basket of top 10 DeFis, and they 10x within 6 months, and you continue to dollar cost average, because it is constantly thrown in there. I'm not even talking about the stimulus checks, but definitely we're seeing a dollar cost averaging has really taken over since around probably, when Bitcoin right around the 30,000 area. To me, it became extremely obvious that everything was coming in. But over the summer, of course, with DeFi, it, substantially different than 2017 too, because it was, two dudes in a white paper in 2017 raising hundreds of millions of dollars, and now you actually have real businesses, real assets. It's an amazing time.
Yeah, and you have fundamentals supporting the price growth. I mean, not in all cases, but I think a lot of the people who are not in this asset class yet just assume that these kind of returns are unsustainable and therefore it must be a bubble. What they don't understand is that there's a big difference, right? Like when Bitcoin goes higher, you can't value Bitcoin. You can look at it on a relative value basis and say that the overall market cap is lower than it should be if you believe it's digital gold or if you believe it's money. But there's no real way to value Bitcoin. You can trade it, but you can't value it. But you can value a DeFi asset. For instance, Uniswap, one of the largest decentralized exchange, when it was trading at $2 when it first came 6 months ago, it was trading at a price to sales of about 3 times, and they were run rating about $300 million of annualized revenue. Well, now the price is $30, right? It's up 15x, and ultimately, you could argue that, okay, well, therefore it must be expensive. It's time to sell. But the reality is they're now run rating $1.2 billion of revenue.
Yeah.
Their growth has been tremendous. And I think that is, the price to sales ratio is a little higher now. It's, it's a little over 10 times versus around 3 times, but you could warrant that this should be trading at a 50 times price to earnings based on the growth, right? Now, Nexus Mutual is another favorite example I have. Nexus Mutual is insuring all of DeFi. If you believe that DeFi is one of the biggest growth engines, then you would argue that insurance on these DeFi protocols to protect against those hacks is something that is going to be huge. Well, Nexus Mutual has $300 million worth of Ethereum in their capital pool. The net market cap of Nexus Mutual above that capital pool is like 50 million bucks. This is insane, right? I mean, like, it is trading at 1.1 times book value versus, look at other insurance companies like, Zoom or Lemonade, and they're trading at 30 to 40 times book value. So, even though the price of Nexus Mutual is up 5x in the last 6 months, you could argue that it's still incredibly undervalued. And I think that's where, when you start to really do the research and you start to really do the work on what's happening in this ecosystem, you'll realize that price does not mean cheap or expensive. Well, the fundamentals are real, and they're growing faster than any other asset class we've ever seen.
Yeah. Well, it's as if it's as if you have the ability to have early access to venture type returns in a highly ish liquid environment without having to meet the teams and without having to go through deal sheets and, putting on your vest and going out and doing the meeting and, all the stuff that VC type work involves. Your Patagucci vest is key. So it is, and it's very, very simple. In a venture world, you're pre-revenue a lot of times. You're sometimes pre-product, or certainly pre-product market fit or whatever, and you're getting the same sort of returns that we can get, or we have gotten, I guess, recently in the last 6 months. But you can do it from your home. You can do it from a spreadsheet where you can pull down 1,000 assets and come up with some sort of financial model to compare these against. PE probably is, just based on this one, is the easiest way to look at that. That seems like a pretty easy one to throw in a spreadsheet. Sort it by the price PE ratio and what your tier of expensive, cheap, and undervalued is, and probably just get after it. That's a fairly simple analysis.
And a lot of these tools are freely available. It's the fact that most of the investors in the space aren't thinking that way yet, right? We mentioned the VCs are generally not looking at that because they're looking at pre-revenue, pre-product anyway. The traders are certainly not looking at that. They're looking at charts. But this information's out there if you choose to look at it. I mean, there's a great site called Token Terminal where you can look at the price to sales and the price to earnings and the price to book and all these different metrics, and it's calculated for you. So what we found the most interesting when we started ArCa is we had to dig really hard to get this information when we first started valuing these companies. I mean, we have investment memos and models for every investment we make, which is obviously counterintuitive relative to a lot of the people's perceptions of the space, which is that it's just being traded for the sake of trading. But we had to invent a lot of these models. There is no Graham and Dodd or Frank Fabozzi in this space yet. We had to be those people ourselves. But now it's a lot easier. This information's out there. There's a handful of people providing this data. There's just not that many people interpreting the data, right? There is still a lot of information that goes undetected or undiscovered in this space that traditional financial analysts and traditional traders could take a look at this and recognize, like, wow, this is up 10x, but it's still cheap, and I still want to own it.
Sure. Yeah. Well, and kind of the nativeness of the digital currency means that it kicks off a tremendous amount of data already. So it's pretty much you, the individual, deciding, I would like to pull this data down and analyze it, or Token Terminal, Masari. There's so many data visualization and analysis tools out there that are free for so much of it. And then, if they do a good job, they wrap it up in a monthly fee or something like that. If, to support the work of 5 analysts to really deliver great products. So this is really cool.
Yeah.
I pulled up
And the irony, of course, is that a lot of traditional analysts are waiting for the Coinbase IPO or the direct listing, right? Because they're like, well, that's a company that I can model. Well, once you actually build your model, you'll realize that basically 95% of their revenue is driven by the price of Bitcoin anyway. So
Right.
after you go through all the modeling, you'll realize that this is just massive operating leverage to Bitcoin, and that's no different than Galaxy or Anchorage or any other quote unquote crypto stocks that are out there. They're highly levered to Bitcoin. There's a lot of money and wealth that is directly tied to the fate of Bitcoin. Whereas when you get into DeFi and Web 3.0 and on sports and gaming and NFTs, this is an entirely different asset class that just happens to share the same digital asset wrapper. And the investment drivers are totally different. So, by all means, if you are looking at these crypto stocks and you're looking at, Bitcoin, you should be expanding and looking at these other areas, because you'll find that it's one of the few asset classes left that is not overly saturated by hundreds of people looking at the same information and drawing the same conclusions.
Yeah, that's easy to see. Yeah. Well, I'm going to start wrapping up here for you, let you get back to your day. But the last thing I wanted to ask is, oh, this is kind of a speculative thing, but how much do you think Coinbase of their IPO that they're going to buy digital assets with those proceeds? Or do you think that will happen at all?
Well, there's not going to be any proceeds. They're not doing an IPO. They're doing a direct listing. So with and that's partly by design, I believe, because as a result of doing a direct listing rather than a sale, they don't have to lock up any of their investors. So their investors are liquid on day one rather than having a 6-month lockup. But also because this company is just printing cash right now. I mean, they did $1.3 billion of revenue last year. I bet they do $1.5 billion this quarter alone, just because Bitcoin is up 4x. This is a $6 to $10 billion revenue company that's probably going to fetch $100 to $150 billion equity valuation, and for good reason. I mean, they were just printing money. I don't think that they will use that money per se. I don't think they're going to use the cash on their balance sheet per se to invest in digital assets. But what I do think is that there's a ton of people in this ecosystem. They're going to get very rich off of this direct listing, and they're going to pour that money into the ecosystem. So they're going to start their own venture arms. They're going to invest directly into these assets. So we talked about asset rotation, just like in the equity market where the rotation is happening into banks and energy right now. The same thing's happening in digital assets. All this new money that's coming in from Wall Street to buy Bitcoin, that Bitcoin money is being recycled into Ethereum and Solana and Algorand and Polkadot, et cetera. And ultimately, this is going to be a huge boon to the entire industry, in my opinion. I think the Coinbase listing is going to be a pretty watershed moment for the industry.
That's exciting. Yeah, I was kind of hoping that they would just IPO and then buy Bitcoin or ape into something 1 inch or something. Just go.
Yeah, I mean, I don't have any insights on that. They very well might, but they're pretty levered to Bitcoin already as it is.
Sure. Yeah, they did pretty good. All right. Well, it was great chatting, Jeff. I feel like I cut this thing way too short. Probably could have gone on for a lot, and I'd be happy to follow up with you in a little bit more, maybe on a quarterly basis, or when you have another, put out some more blog posts that are start stockpiling. We want to get in, discuss that stuff, and as things change, is there anything where should people find you?
Yeah, absolutely. Thanks for having me, Chris. A lot of fun. Love to do it again. People can find me on Twitter at jdorman81. They can find us on our website at ar.ca, and they can read our weekly blog. That's our 2 Satoshis. And obviously, accredited and qualified institutional buyers can reach out to us directly via the website to discuss any of the product offerings that we have.
Great stuff, Jeff. It was a good time chatting.
Great. Thanks for having me, Chris.
All right. Thanks.